Here, let's kick it off since we just ended with Microsoft. Your take on the Microsoft quarter.
It's all about Azure, and they didn't need to hit that bogey that Google set, but they did need to see an acceleration in Azure. Of course, they showed that from 29 to 31. I was expecting that 10 points of that growth was going to come from AI, which is effectively their OpenAI relationship. In fact, 12 came from it, which means that their core Azure business, excluding AI, has been stable, growing at 21% despite the law of large numbers. The other piece I'm really cued in here, too, is to hear some real substance on the call about Copilot adoption. Last quarter, they had 31 comments in their prepared remarks around Copilot. None of them gave any sort of real substance in terms of what this actually means in terms of monetization. And so I'm going to be keyed into that.
We didn't get any numbers, right, Gene? I mean, I think that they spoke in sort of broad directional terms, like the number has doubled or something like that, but they didn't actually give a firm number on Copilot customers.
That's correct. I mean, they are just, I'd say, notorious. Amazon does the same thing after Cyber Monday, is give just a barrage of data points that you try to triangulate. That's been kind of the MO regarding this whole Copilot adoption. They did say probably the most substance data point last quarter was that 40% of GitHub revenue has some sort of Copilot. GitHub's a small percentage of their business, call it 5% of their business, so it really doesn't matter. We're still looking for, I mean, at the end of the day, this 30 extra bucks a month, what does it mean to what has it meant to their revenue and their bottom line? And they have been avoiding that question. I don't think they're going to answer it today, but that's what I'm going to be cued in on.
Gene, do you think it's expensive right now? Would you be, I know it sounds like you're waiting on a couple of different things to sort of get you over that bubble, but you heard the conversation before where it looks expensive to itself. Would you wait here to see if they are in the prove me state because of, you know, how they've come so far so fast?
I think so. I mean, the bottom line is that this is probably the most stable of any of the mega caps when it comes to AI. They grew 14%. They just reported quarter expectations of 14%, and then again 14% for 25 and 26. And I think you pay up for that, Steve. I think that's one piece.
And once again, that forward P you're looking at there that they're showing, that's likely incorrect. The reality is they keep smashing these numbers. The forward P for Meta is probably a 22 right now. Probably a 22. Whoo-wee! There is potential that forward P could be under 20 when it's all said and done and the dust settles. But I would say probably a 22 is realistic. That's crazy.
This is a relative game.
Way too much
which one of the
growth
mega caps have kind of the best upside relative to valuation. And I think Microsoft, they're doing a lot of great things. I don't think they kind of hit that. So the bottom line is I still think that this is expensive relative to an opportunity like versus Google.
Hey, Gene, it's Karen. Just to follow on that expensive, what do you think, where should this be trading? What's the right multiple you would feel comfortable with?
Probably the mid to high 20s. If you're going at 14%, that feels like a good number. So we're a ways away from that, I think, kind of on the out year numbers, but that's, I think, a good number. I would also say I think Google should trade at the mid to high 20s, and it's probably after today right around 20 or 21 times, 22 times perhaps. But again, I think if you look at the AI opportunity and say which company is best positioned, I think Google is a better positioned company.
Let's switch gears to Meta, Gene, because I do want to get your take. And the conference call is about 14 minutes, and we've gotten a couple of headlines. Steve had referenced one of them, the CEO saying that Meta AI now has more than 500 million monthly active users. A second headline says Llama 4 models are training on a cluster that is bigger than 100,000 H100 GPUs a day, which, I mean, it gives you the sense of NVIDIA's business for sure, but also just how much intensity and focus there is there on AI and getting that model right, Gene. So what is your take on the quarter here?
So the quick take on the quarter was related to what the guidance was. They typically come in at the high end of the range. That would imply 20% year-over-year revenue growth. They just reported 19%. So understand it had a high bar. They did guide. I view this as a guide of a fractional acceleration, which is positive. Those numbers quickly, that 500 million number, that was a number that Zuckerberg also gave us a few weeks ago. And this kind of this.
Also keep this in mind. Whatever they guide for, guess what's probably going to happen? They're probably going to come in and beat it. This is Meta. They come in and beat these numbers very regularly. So, like, I never would put too much faith in the guide in terms of like thinking that's the number. My thought is if they guide for, let's say it was 19% revenue growth, my thought is they're probably growing 20 to 22%. The reality will be in the end, right? If they said 17%, then I'm thinking they're probably 18 to 20%, somewhere in there roughly.
Flexing around how much these companies are spending on all the output. All that's nice to hear. What matters is this, is Zuckerberg's closing comment on the earnings call. He just said that this is the most unique moment that this company has ever had ahead of it. And they are going to be aggressively investing in that. And I think that's what you're seeing with all this GPU. They're going to be on that, stay on that accelerator. And I think that that's a good sign for Meta investors because clearly this is having a tangible impact. Probably of any of the mega caps besides NVIDIA, Meta's actually seen the tangible impact of AI faster than any of them.
Gene, thanks. Always good to see you. Gene Munster, Deepwater Asset Management. Tim, your take.
Well, I think on Meta, the Reality Labs feels kind of like an albatross right now. I mean, it's 22 billion loss. Maybe it's not. I don't really know. And I think it gets back to this is not the business we're all looking for at Meta, and we are looking at the core business, which has evolved to a place where now AI is delivering margins and the company to actually be deserving of a valuation probably higher than the multiple it traded at in the past. That's the part of this that's fascinating because I just, he continues probably higher than the multiple it traded at in the past. So that's the part of this that's fascinating because I just, he continues to press Reality Labs. That continues to be a loss leader, and that's something the market's given him a pass on.
Yeah, 100%. But again, I go back to it. This is 2 quarters in a row now for Facebook where AI has seemingly helped, and it's helping the metrics that I think are important. Karen said it, average price per ad, double what the street is looking for, and their margins are improving, so you can actually justify the spend.
ARPA, by the way. I just did that acronym.
Did you?
ARPU.
Per ad.
But it's
average
ad.
Yeah,
It would be an ad
price,
as opposed to user.
Okay.
Yeah.
I love this acronym. It's nice. It's fun. So
Anyway,
sorry.
it justifies the spend. That's the short term.
Coming up, more after hours action shares of Coinbase, Robinhood, and Starbucks on the move after.
No, 100%. They can definitely get away with this crazy CapEx right now, which is insane numbers, and they can get away with the Reality Labs spend because they have the revenue growth to support that, right? If they didn't have this revenue growth, that might be a different story, but they got it. So very happy Meta shareholder. Congratulations to anybody that's a Meta shareholder out there. Hopefully you've made a tremendous amount of money on this stock, and hopefully you make a lot more. Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That is my personal advanced software that I use to make my investment decisions when I go to invest in companies. As somebody that's been in the market 15 years, I got sick and tired of using these different services that folks have out there that are designed for traders in the market. People that are looking to get in and out of stocks. That's not what I'm here to do. I'm here to long-term invest. I need to be able to see all the different ratios and metrics that are very important for me as a long-term investor to judge if I'm getting a great deal on a stock or if I'm getting ripped off on a stock. I need to be able to compare different companies versus each other and be able to do that in a matter of seconds rather than it taking hours like it used to before I created this service. I want the ability to listen to conference calls, see SEC filings all in one service. That is what we've created with 1000xstocks.com. If you are looking to access this software, go down to the description area of this video. You can click the link down there and apply for access. If you don't want to do that and you want to search a website, go to 1000xstocks.com. Enjoy it. A lot of blind spots in this market. Let's go through the first one. Oh my gosh, are people making a big mistake in regards to this one? And when I say people, I'm talking about Wall Street. They think the move in Meta's done. Right? They don't think Meta is going to keep moving higher. Like, no, like that's about it. They think this move that's transpiring today, they think that's the reality move, and that could not be further from the truth. You got a whole situation coming for you, okay? This was Meta's income statement they just reported. They reported revenue that was up 19%, income from operations that was up over 25%, net income that was up 35%, and diluted EPS up 37%. That is not a business model that is in any sort of position where it's not going to continue to go up quite significantly. And so this sets up Meta for another amazing year in 2025 in regards to their business model and in regards to their stock price. And I'm going to take you through in just a moment a shocking move that's about to transpire in the stock price. I don't think a lot of people are prepared for, right? Now, the market maker is destroying everybody in the short term, right? A lot of people kind of playing call options on Meta, thinking the stock was going to go 615, 625 after earnings, right? 630, 650. They thought there was going to be an epic move here, and the market maker is just destroying everybody. There's no big downward move. There's no big upward move. And so the market makers just give me the money, give me the money, give me the money. And everybody that was buying put options and call options on Meta stock, thinking this stock would move huge on these earnings, is getting absolutely wrecked. Absolutely wrecked. And this is just another reason why you don't try to play these short-term games in the market, because they always got the angle on the short term. They always got it. You focus over the next several years, you now are the house. You're either the player at the casino or you're the one that's running the casino. You can ask yourself what you want to be. If you want to be the player at the casino, sometimes you can win. Most times you're going to lose, right? If you want to be the house, guess what? Most times you win. And so as a long-term investor, you flip this and now you're the one in advantage, right? But these people that try to play these short-term gains, I'm going to buy a bunch of put options, Meta's going to tank 10, 15% on earnings. I'm going to buy a bunch of call options, Meta's going to go up 10, 20% on. They're all just got wrecked. They all just got obliterated, right? And even the people that thought, oh, I'm going to outsmart the system, I'll buy puts and calls because one of them is going to hit. Those people even got destroyed because neither one ended up hitting, right? This little teeny move here. But this is not the reality move. The next move up here from Meta is going to be $700 for the stock. Now, in regards to Meta, they beat 7 straight quarters. And when I say beat, I'm talking double beats. Earnings per share and revenue. And some of these beats have been substantial, including this latest quarter beat, 73-cent EPS beat. That's shocking. Shocking number in regards to that, right? So Meta just continues to beat, which means what? This is what it means. The numbers, the projections you see for Meta are all likely off. If the company continually beats analyst expectations in regards to revenue and especially in regards to earnings per share, then likely the forward P you see is much lower in reality than what it says, right? So you look at a forward P, because this is judging off of, analyst expectations on average, right? It says, oh, Meta's trading at a 24 forward P, which is still a steal deal given the growth rates this company has. But the reality is it's likely not trading at a forward P of 24. The reality is the forward P for Meta is likely 15 to 20 right now. That's like where the market trades at in general, right? 15 to 20 forward P. But the thing is, Meta's growth rates are significantly above an average stock in the market, which means the valuation should be at least double where it's at right now, right? Next year, earnings per share growth, analysts are at high single digits. They're probably going to do 20% plus. Next year, revenue growth, analysts are at around 13, 14%. They're likely going to do 15 to 20% revenue growth next year. So all these numbers you see are all likely too low. Now, I have news for you. Meta stock's going to hit $1,000 plus in 2025 or 2026. $1,000 plus in 2025 or 2026. And here's why. Run some valuations on Meta, right? 17% revenue growth on average for the next few years is pretty realistic for this company overall. Net income growth of 25% is significantly under what they've been doing recently. And even with that lower number there, you're basically setting this company up in a position where they should be 70 billion plus in net income in 2025, and I don't see that being a stretch at all. And it should push close to $90 billion of net income in 2026, right? Now, a PE range on the stock should be somewhere in the 30 to 40 range, right? Considering, you've got 15% plus revenue growth, and then let's call it 25% type net income growth. You should be somewhere in the 30 to 40 PE range. So that puts this stock somewhere between $825 and $1,100 next year, 2025, right? That puts the stock somewhere between $1,031 and $1,375 in 2026, which is why the stock will be $1,000 plus in the next 2 years. And so you look at the stock at 500 or so today, hey, cool, it means nothing. The fact that the stock's done so tremendous over the past 2 years, and look at the last 2-year chart of the stock, and how much money folks like myself have made, made $800,000 or whatever in the stock, it's all irrelevant. The bottom line is there's another double up coming here in regards to Meta. And the best part of this whole situation is a few years after that, another double's coming. Another double's coming a few years after that, and the stock will go $2,000+. That will probably be, I would say, 3 years-ish, 3 years, somewhere around that, after the stock hits $1,000. So let that sink in for a moment. We got a double up coming, and then we got another double up coming right after that, okay? Now, the other thing that is amazing here in regards to Meta is they have something significant going on beneath the surface right now that not a lot of people are factoring in. I can tell you, no one's really factoring this in. The Llama models are incredible. And they continue to attract more and more folks to use the Llama models, which is going to be absolutely massive in regards to LLMs and AI in general, right? Nothing's priced in here in regards to stock, in regards to Llama. I mean, nothing is priced in. So as people begin to understand that opportunity better and better over this next several years, you're going to start having hundreds of billions of dollars of market cap be priced in for Llama, if not $1 trillion plus. But it's going to take several years for people to understand that. But zero is priced in regards to stock right now, right? Amazon is trading way too cheap right now. This stock's going to be 300 plus 24 months from now. People are completely missing the whole opportunity here in regards to the e-commerce side, the advertising side of the business, and the AWS side, and how we're likely going to see a reacceleration of growth in regards to AWS. This stock's trading way too cheap. It's trading 185 here today. Any dips you get on this stock is a great buying opportunity, especially if you're looking for a piece of steak in your portfolio. Amazon is that piece of steak. We're going to see the earnings per share likely skyrocket in 2025 and 2026 for this company. 300 plus is coming in the next 24 months for this stock. It's trading way, way too cheap. Like I said, every dip on this stock is 185 here today. Any dips you get, or just be thankful. That's all I'll say about that. Be thankful. AMD, investors are making a big mistake in regards to AMD. Big mistake. They're starting to get too impatient in regards to Lisa Su and AMD. Okay, and so if you look at the stock, basically the stock hasn't moved in 3 years. Pull up a 3-year chart of it. Here it is, and look, the stock's gone nowhere for 3 years. That's incredible. Investors are now at a stage where they're actually getting too impatient, I'll say, with Lisa Su and what AMD's doing. And by the way, Lisa Su, I remember when this company was a $2 stock shortly after she took over the company, right? It was a $2 chuck, and it's $144 here today. One of the most amazing big tech companies in the world. You got to understand with AMD, they have two main businesses and they have two minor businesses. Their main businesses are data center and client segment, okay? Their two minor businesses are the gaming segment and embedded segment. Now, in regards to their two main businesses, they're booming. Data center segment revenue was up 122% year over year. That's incredible. Client segment revenue was up 29% year over year. But they have two minor businesses. Those ones are in a troubled spot right now. Gaming segment down 69% year over year with their revenue. Horrible. Embedded segment down 25% year over year. Oh my gosh, those businesses are a disaster. Not so fast. Those businesses are both showing signs of bottoming right now. How do I know? You got to look deeper into the numbers. Look at what we find right here, okay? The gaming segment was down 29% sequentially, but it was down 69% year over year. That's a sign when the sequential numbers start getting way less than what the year over year numbers are, you know you're already in a bottoming stage in regards to that particular segment. So what we're going to likely see is a gaming segment start to sequentially improve probably in the next 2 quarters. In the next 2 quarters. At the latest, probably 3 quarters out, but likely in the next 2 quarters, you'll start to see on a sequential basis gaming actually improving for AMD overall. Now, when it comes to the embedded segment, this business has already bottomed. How do we know? Look at on a sequential basis. On a sequential basis, which is just a fancy way of saying quarter over quarter, revenue increased 8% as demand improved in several end markets. So yeah, the numbers might be down year over year, but they're already starting to go up again on a quarter over quarter basis, which shows you those minor businesses are already in the bottoming stage, and the two main businesses are booming and likely going to continue to boom for quite some time, especially in regards to the data center business there. So don't get too impatient in regards to this whole AMD story here. I'm even looking at this one saying, ooh, this might be a great opportunity. Grade A income statement they reported here. Revenue $6.8 billion versus $5.8 billion. If you look at gross profit, $3.4 billion versus $2.8 billion in the same quarter last year, right? Operating income, $724 million versus $269 million in the same quarter last year. And net income of $771 million versus $265 million in the same quarter last year. Diluted EPS well over 2x from 16 cents to 47 cents. So AMD's looking really good here. A lot of people are gonna be looking back at this one and be like, what were we doing here? Toll Brothers. Toll Brothers average selling prices are, guess what? $1 million plus. This is their creme de la creme. This is where they dominate, right? The $1 million plus bracket. And what I see coming for Toll Brothers is I think new order numbers are going to be ugly for the next 2 to 3 quarters. The next 2 to 3 quarters. I don't want to predict a year from now. I don't want to predict 2 years from now or 3 years from now. Too dang hard. There's way too much that can happen 2 years from now to try to predict out there. But I can see the next 2 to 3 quarters in regards to the housing market. And what I see a pretty decent probability that we could see Toll Brothers stock fall to the $120 range. If these numbers are ugly for the next 2 to 3 quarters in regards to new home, because you got to understand, Toll Brothers, people don't care about what Toll Brothers is going to report for their revenue and earnings per share. Those are going to be great numbers. We all know that. You're looking to the future. So you're saying, what's Toll Brothers' numbers going to be a year from now? 2 years from now. And that is, how do you find that out? You look at what their new home order numbers are coming in at. If their new home order numbers are strong, like Donkey Kong, guess what? That means their numbers a year out from now, 2 years from now, when those homes are delivered, are going to be banger. If those numbers are extremely weak in regards to those new home order numbers, guess what? That means their business is going to suck. Their revenue, their earnings per share, their margins, everything's going to suck a year from now, 2 years from now, which then investors say, I don't want to be part of the story during that particular time, and they sell out. And you get a bunch of selling pressure on the stock. And the stock could easily go to $120. I think worst case scenario for Toll Brothers stock is it goes under $100. And that's if not only their numbers are ugly in regards to their new order numbers are ugly the next 2 to 3 quarters, but if you also start having headlines about home prices falling. Because if all of a sudden the mainstream media starts to cover everywhere, home prices are falling, that's going to set up a whole set of dominoes where people that are actually going to sell their homes are going to get way more serious around price when they start seeing it on mainstream media everywhere, when they go on Facebook and they see it, when they go on YouTube and they see it, when they go on Instagram and they see it, when they go on TikTok and people are talking about it on their feed, right? That's a different situation when they put on the TV and everybody's talking about home prices are falling. All of a sudden, sellers start to get real serious real fast, right? And that would be a whole other cycle because no one wants to hold these home builders if the new order numbers are coming in ugly and the headlines start saying home prices are falling. No one's going to want to hold these stocks during that period. And so you could see a very ugly sellout, and it will happen quick in regards to this, which is why one of my main hedge actually I have for 2025 is I put options on Toll Brothers because I'm looking at it and I'm like, yeah, if this thing goes south, which it's kind of looking like it's going south in regards to this home market in the short term, it's not going to be good for these stocks. Oh no, right? Celsius Holdings, I'm looking at you. Another one that I think is bottoming very soon. Listen, if you bought Celsius stock probably in the last 2 years, you've lost money on this stock, right? And so there's another one that I think there's a lot of Wall Street, a lot of investors that are looking at tax loss harvest. Because let's say you're taking big profits this year in Meta or Nvidia or Tesla or some of these other stocks, right? That maybe you made a bunch of money in. SoFi, right? Palantir, whatever. Well, if you've lost a bunch of money in Celsius, a lot of people look at this and say, tax loss harvest says maybe I can buy it back the same price in January, February, something like that, right? And so you get this tax loss harvesting income, right? And this is why I said in regards to Celsius over the past month or two, I told you guys don't trust any rally you get in this stock until you get to 2025 because every rally ends up getting sold off, and that's exactly what we see play out in regards to Celsius, right? It'll make like an 8% move in a day. People get excited about, Celsius is back. And I'm like, not so fast. That 8% move is going to be gone like that. Sure enough, that's what we see time and time again with Celsius. You'll have some big day, 5%, 8% move, 10% move, and it gives it all right back, right? And because at the end of the day, you just got a lot of selling pressure here into the end of the year, tax loss harvesting. And so you can start to trust rallies in Celsius in 2025 and beyond, but don't trust it right now. Don't trust it right now, right? But it's a great time as a buyer, right? This is a time you need to be buying these stocks, Estee Lauders, Celsius, these sorts of companies, Wynn Resorts. The numbers have been amazing out of Wynn Resorts. And this is with a weak China. Everybody talks about how bad China numbers are, right? And yet Wynn Resorts is putting up phenomenal numbers quarter after quarter, right? but they sell, who's their income, or who's their customer base? Top 10% income earners, top 10% of the wealthy around the globe, and they continue to perform tremendous. We're already in a rate cut environment. That's factual, right? Rate cut environment is very good for companies like Wynn Resorts for two reasons. One, these companies usually take out a lot of debt. If you're talking about interest rates being cut, guess what? Debt gets a lot cheaper. Refinancing a debt gets a lot cheaper as you cut more and more and more, right? Additionally, people start looking around for yield. And they say, gosh, my CD account's not paying as much. My treasuries aren't paying as much. My savings account's not paying as much. Where do I look for yield? And you start to look out there, and you got a company like Wynn Resorts that's probably going to be raising their dividend in 2025, raising their dividend again in 2026, and many times in future years, right? And so you just say, gosh, like Wynn's looking pretty good. Like that's a great dividend paying stock that's probably going to keep up in their dividend for years and years to go in the future. Imagine when they hit that Middle East property, goes from costing them money because they're building that out right now, to the money starts flowing in. Oh, baby, okay? And so next thing you know, people start looking at a stock like Wynn and like, ooh, this looks pretty darn attractive. And so you could see immense amounts of money coming to a stock like Wynn over this next 24 months here. And so that's another one that sets up phenomenal.